Hedge fund structures. Open-ended versus closed-ended funds along with assessment section. Open-ended funds. An open-ended hedge fund, also known as an open-ended investment company or mutual fund, allows investors to buy and sell shares directly from the fund itself at any time. There is no limit to the number of shares that the fund can issue, and new shares can be created as more investors buy into the fund. When investors want to buy in or sell out, the fund will calculate the NAV of its underlying assets and determine the price at which shares are bought or sold. The price is usually based on the NAV per share and might also include any applicable fees or charges. Open-ended funds have liquidity, where investors have the flexibility to enter or exit the fund on a regular basis, often daily. This structure makes them more suitable for retail investors who may want to invest smaller amounts of money and have the option to withdraw their investments when needed. Closed-ended funds. A closed-ended hedge fund, also known as a closed-end investment company or investment trust, operates with a fixed number of shares. Closed-ended funds don't continuously issue new shares to investors. Instead, the fund raises a fixed amount of capital during an initial offering, and these shares then trade on secondary markets like a stock. Since the number of shares is fixed, investors who want to buy into a closed-ended fund need to purchase shares from other investors who are selling on the secondary market. This can lead to discrepancies between the market price of the shares and the underlying net asset value of the fund's assets. Closed-ended funds are generally less liquid than open-ended funds because investors need to find buyers to sell their shares. In hedge funds, both open-ended and closed-ended structures can exist. However, hedge funds are often associated with closed-ended structures due to their focus on investors who are willing to lock up their capital for longer periods of time. How open-ended and closed-ended structures can work in hedge funds with examples. Open-ended hedge fund. Imagine you have an open-ended hedge fund called Alpha Opportunities Fund. This fund employs a long-short equity strategy, meaning it takes both long and short positions in stocks to potentially profit from both rising and falling prices. Investors who want to participate in the Alpha Opportunities Fund can invest by purchasing shares directly from the fund at the current NAV per share. The NAV is calculated by taking the total value of all the fund's assets and subtracting any liabilities. Let's say the fund initially has 1 million shares outstanding, and each share is priced at $100. This makes the initial fund size $100 million. Investor A buys 1,000 shares of Alpha Opportunities Fund, investing $100,000. Investor B also invests $100,000 by purchasing 1,000 shares a few days later. The fund's NAV per share remains at $100. After a few months, the fund's investment team has made successful trades, and the value of the fund's assets has increased. The NAV per share is now $110. Investor A decides to redeem their shares and withdraw their investment. The fund pays investor a $110,000, 1,000 shares $110 per share. Meanwhile, investor C learns about the fund's performance and decides to invest. They buy 2,000 shares at the current NAV of $110, investing $220,000. The fund's NAV per share remains at $110. In this open-ended hedge fund example, investors can join or exit the fund at any time by buying or selling shares directly from the fund. The fund's NAV per share reflects the value of its underlying assets. The fund continuously adjusts its share issuance based on investor demand. Closed-ended hedge fund. Now, let's look at a closed-ended hedge fund named Global Macro Opportunities Trust. This fund focuses on global macroeconomic trends and uses a variety of strategies to capitalize on them. The Global Macro Opportunities Trust conducts an IPO to raise capital. It issues a fixed number of shares to investors during the IPO, let's say 5 million shares at $20 per share, raising a total of $100 million. Investors who missed the IPO can still invest in the fund, but they need to purchase shares from existing shareholders on a secondary market like a stock exchange. Since the fund has a fixed number of shares, the price of the shares on the secondary market might trade at a premium or discount to the fund's NAV. Over time, the fund's portfolio performs well, and its NAV per share increases to $25. However, due to market demand and supply factors, the shares on the secondary market might trade at $23, creating a discount to the NAV. Investor D decides to invest and purchases 1,000 shares from an existing shareholder at $23 per share, spending $23,000. In this closed-ended hedge fund example, the number of shares is fixed, and investors can only buy or sell shares on the secondary market. The price at which shares trade on the market might not always reflect the exact value of the NAV. Let me help you by creating a knowledge assessment section by asking few questions. 1. Can you explain what an open-ended hedge fund is and how it operates? 2. How does the pricing of shares work in an open-ended hedge fund? 3. What is a closed-ended hedge fund, and how does it differ from an open-ended fund? 4. What are some advantages and disadvantages of investing in a closed-ended hedge fund? Please mention you answer in comment and feel free to let me know in the comment section if you did not found the answer, and I'll gladly assist you further. Thank you for watching. If you found this video informative, please hit thumbs up and share it with your friends. And if you're looking for more insightful content, consider subscribing to my channel. Your support means a lot. Until next time, take care and stay curious.